What's up, guys, and welcome back to another weekly studly stocks report with your host Talos. And of course, in today's video we got quite a few topics to talk about. I always say few, but it turns out to be quite a bit. But of course it is the stocks, and this is what we're going to be talking about in today's video. We're going to briefly talk about some of these. Of course, that's Talos Energy, Moderna, Johnson & Johnson, Neo. Those are kind of stuff we're going to briefly talk about. But the rest of the ones, the brand new ones that we're going to talk about is Skechers, apparently in the news, for being the highs, one of the only highs really, and one of the only highs for the week that I really want to talk about. And of course, some of the big lows. The big lows. Netflix, what? In the lows? Yes. Riot, which is Riot blockchain, it might be linked to Nvidia, maybe, and it also might be linked to Coinbase, which I forgot to add, but now it's there. But yeah, guys, that is the topics. Let's go dive into some of them real quick. Now, of course, Talos Energy is the boys, the bad boys. They haven't done much of anything. They actually went down quite a bit this week. But nothing. There's not much in the news in Talos Energy, but we have to keep that energy up, guys. As you know, guys, it's named after me, so we got to kind of keep watch on them. But what we talked about last week, guys, if you haven't seen our last week's video when it comes to Moderna, Johnson & Johnson, and of course Pfizer, definitely check out last week's video. And it looks like they're in the news again, and they're also again up. Now let's flip to the charts real quick. This, of course, is Moderna. Now, if you guys recall, this is the 5-day history. They was as low as 154, as high as 178. If you guys have been following the news on Moderna, they're definitely trying to push for a booster shot, and it's supposed to be coming out later this year, right around I think September, October, kind of like fall time frame, just in time before winter hits. And I think when potentially, hopefully not, but potentially another wave might come into fruition. But obviously they're just preparing for it to try to keep everyone safe, and that's of course why Moderna is going up. And the same applies for Johnson & Johnson. They're also been up this week. They were like super low last week. I shouldn't say super low, but they weren't as high as it could have been compared to like Moderna or even Pfizer. The reason why Pfizer is not in this list because they actually kind of remain stagnant this week. There's no significant growth or even significant decrease from Pfizer because there's just no news on if they're also going to do a booster shot as well. That's why the big kicker here for Moderna. Now that is pretty much what I want to talk about briefly on that. If you guys want to learn more about that or whatever, definitely check out my video last week. And of course, in the comments, we can have a long discussion about it as well. But before we roll into some of the bigger pieces, of course, we have to pay a little bills. A word from our sponsors. Now, of course, a word from our sponsors to pay a little bit of bills is, of course, Public. The Public app, known for investing, a social environment where you can invest and also kind of like follow other people and how they invest as well. If you want to follow their lead, their advices. If you don't want to take my advice, they might be financial advisors, unlike myself, and they might be able to guide you into a better route. But of course, this is a great social environment app. Everyone there is super friendly, super close knit, and of course you're just following other people with a similar niche. And of course, if you guys use our link down below, you get up to $50 of free stock. Now it's more of a slice of stock, so it could be a slice of Tesla, it could be a slice of Netflix, it could be a slice of any of the stocks we talk about in today's video. So if you guys are into that and want your own slice of stocks up to $50, definitely check out our free link down below. Now, of course, let's move on to some more of today's topics. Now, what I failed to mention in the intro, of course, is there's actually one more stock in there that we're going to discuss a little bit, and we're actually going to bring a friend of mine to kind of like maybe discuss a little bit about it, and that's of course Square Enix. Now, the reason why it's not listed there is because there is no Square Enix publicly traded stock in the US. It's only in Japan, and actually they've been going up this week, and I kind of want to talk about that a little bit later in this video. Go ahead and clear some of this real quick. Now, of course, we're not gonna go harp in too much of it, but Neo is in the news again for going up, actually much more significantly up than Tesla, which we're actually gonna add into this chart real quick. Another inverse from last week as well, but we're just gonna kind of briefly look into it, maybe check out some news to see what triggered it. But Neo is finally above $40, and that to me is super exciting. They're nowhere near their highest. I think their highest is at 60. but it's getting there. And of course, that's what excites me. Of course, they are a EV company, electric vehicle company, and they are amazing. As an investor, especially someone who bought in super low, this is what you want to see. Super, super exciting. Will it go down next week? Probably. But for now, we had to celebrate some of the wins so far in the stock market. Now, last week I showed like some cars that they have in production, and a lot of them look super classic, super nice, and to be honest, a little bit better than Tesla designs. And just my personal opinion, of course, but Tesla, of course, is no slouch. Of course, Tesla, of course, sitting at a comfortable $729.40 per share, which is crazy. Now, of course, last week they were sitting around around 675 roughly, so they went up quite a bit last week for some of the news that they came out. Now, of course, if you look at the chart right now, they are just sitting kind of stagnant. Unlike NIO. Now, as I was saying, this is what you want to see out of a company that you're invested in or something that you really care about. And they have been going up. As I mentioned before, they were as low as 35 all the way as high until closing, until $41. So we're going to briefly look into some news articles to see what might have triggered this huge spike and huge inverse spike compared to Tesla. All right, this is a news article from Yahoo. You guys remember those commercials back in the day? Gains as the market dips. What you should know, and I definitely do want to know. The stock outpaced the SP 500 daily loss of 0.92%. Coming today, shares of the company that lost 10.32 in the past month, which is true, they lost quite a bit in the past month. Oh, they're talking about the entire sector, okay. So the entire sector actually gained 2.25. That also includes like Tesla, it also includes Workhorse, anything that's like automotive and, you know, like stuff like that. The big takeaway here is investors might also notice recent changes to analysts' estimates for NIO. These revisions typically reflect the latest short-term business trends, which can change frequently, which is very, very true. Now, as much as I want to harp on the positives of NIO, it also shows a little bit of negative news here as well. So definitely kind of pros and cons, and you kind of make your own judgment of what you want to do with this stock. Now, of course, I'm not a financial advisor. I can't tell you what to do with your money, but I'm just showing you what articles are shown to me, and you can just make a judgment from that point on. But with this article, it says it's in the eye of the storm, so avoid it. Now, despite hanging tight between $35 and $40, NIO stock is ready to take another tumble. And we're gonna try to find out what this guy is trying to say. Even though the stock may go down, it doesn't really affect me that much because I might actually try to buy it more when it's lower. I typically don't like buying stuff when it just keeps going higher and higher because you just never know when things are gonna settle and like it just crashes down, whatever the new case is. Now, the big reason why it went up is, of course, detailed back in April 9th. Investors were satisfied with a solid March delivery numbers. Now, if you guys remember, that was when they delivered 100,000 vehicles in total, and they were satisfied with that. And of course, Elon Musk even tweeted about it. So of course, that's a huge achievement, huge milestone for NIO. Now, what sorts of new development could hurt NIO? Mainly the potential for April's delivered numbers could fall short of expectations. March numbers, which showed a month-over-month increase by around 30%, may have been sufficient, but given what was increased but due to the Lunar New Year falling in that prior month, this month's substantial growth will be substantially lower. If NIO fails to deliver in the growth department, it will be tough for shares to maintain their still premium valuation from forward price to sales ratios at around 11.8. Now, of course, there's always going to be rising competition in China. Some of the rival companies, of course, is BYD company, Xpeng, and also a global competitor, of course, Tesla. And of course, Volkswagen can also be another competitor as well. A lot of these are not available to be bought over-the-counter markets, but of course, Tesla is viable in NASDAQ. And I thought Volkswagen is also available, but only available over the counter. And according to this article, global expansion may not save the day. Moving to Europe will help the company diversify globally, but on top of that, though, it may pave the way for NIO's eventual expansion to North America. However, he says that even though it's going to expand outwards, they're going to be competing against Tesla, and they're always going to be called and compared as the next Tesla. And a lot of people are saying that it could potentially be as high as Tesla, but Tesla owns a huge market right now, especially in the EV community. It's a big shoes to fill for sure. It's vastly too early to say how this global expansion will pay off. As I always mention with any stock, it's that wait and see type. It's like something you really have to believe in. If you believe that this can do well for the company, definitely buy it right now when it's low. But if you don't believe it and you think that it's gonna like fail and all that jazz, then definitely don't buy in, because that $41 can easily go down to $5 and you just lost a good chunk of your cash. That's the kind of risk that I'm taking for myself, and of course other people also believe in this company as well. If they do expand to Europe, they do expand to North America, now we have a direct competitor to Tesla, and now that's when things get a little bit more interesting. So I'm very, very excited for the potential of what they can possibly do, not only for the stock, but also for the EV community as a whole, especially the consumer market. If I can, I would love to see if I can even maybe get a Neo. And that'd be a cool car review. And of course, I'll probably put that video in my main channel, none other than Talos, which of course have linked down below. But of course, let's not harp too much on Neo. This is a lot of the potential and what could possibly happen. So let's move on to something else. Now this one is actually brand new into the Steadily Stocks report, and that is of course Skechers. Now I personally never use Skechers ever, not even once. I know what Skechers are, I know what they do, I know what they look like, but I just don't have them. Not because I don't like them, maybe partly because I don't like them, but because it just never occurred to me that it's one of those things that I could get. But they're doing pretty well this week. In fact, one of the only highs that I want to talk about this week, and that is of course Skechers at a beautiful $51.90. But let's look at the charts. Of course, Skechers, for those that may not know, design, develop, and market the diverse range of lifestyle footwear for men, women, children, and of course performance footwear for both men and women. They're of course available in the United States and over 160 countries around the world. So they are definitely global. $51 is actually pretty high for a shoe company. If you compare it to like Nike is like, I think 80, maybe 90 per share, I forget. Now keep in mind, Nike did multiple splits to kind of lower that price value and stuff like that, but they're still sitting at a pretty equally balanced in terms of the price value. But when it comes to the actual market cap, of course that's vastly different. Going by the chart right now, they were sitting as low as $43, and now of course as high as $52, $51, finishing off the day at $51, almost $52 pretty much. And I'm betting to say that they did pretty well in the earnings report. So that's what we're going to dive into that and see exactly how they broke their earnings report. So why did Skechers stock soar today? According to Motley Fool, it soared on Friday following the release of the company's financial results. I called it. For the first quarter of 2021, to summarize, it generated record revenue, market rebounded, and Wall Street loved it. And of course, stock went up more than 16%. Hot damn. With the pandemic hurting physical retail, Skechers sales fell 12% in 2020. However, when sales in the fourth quarter were down less than 1%, showing a much marked improvement, investors didn't really know what to expect going to the first quarter because management hasn't provided any guidance. Therefore, it was a pleasant surprise to see a quarter when sales were up 15% over a year to over $1.4 billion, a record quarter. That is huge. Contributing to the gains today, a Morgan Stanley analyst believes Skechers stocks is poised to continue outperforming this year, continuing to the fly. Well, according to the fly, sorry. This bullish outlook is due to the upbeat guidance from Skechers management. For 2021, management believes it will generate revenue for $5.8 billion to $5.9 billion. And just for a bit of perspective, according to this top line guidance is roughly 12% higher than its pre-pandemic revenue in 2019. Right there, boom, explains exactly what happened and why that spike. And of course, normally when you see a chart like that, it's typically because of earnings. It clearly shows from the chart alone why it's part of the highs of this week. So of course, that was a brief summary of that. Now we're actually getting into the lows for the week, which is pretty much the rest of the video. Now, of course, Square Enix itself is also in the high as well this week, but we're gonna save that for the end of this video as we expect a call from one of my good friends, Chris. Now let's go ahead and go into the next stock, which is of course Shopify. And holy bejesus, they are expensive. Once we get the chart, you'll see exactly how much. Well, you can see it right there, $1,099 for one. They have never split, I don't think. That's probably why they're so expensive. They're almost like the Priceline. You guys know how much Priceline is, by the way? They're actually called Booking, actually. I think I guess they merged or changed their name, but they are $2,395 per one share. They're pretty much as high as like Amazon, but Booking has never did any splits whatsoever. They include Priceline.com, Kayaks, Agoda.com, Rentalcars.com, Open Table. Yeah, they're huge and they are super expensive. Obviously, in the comments down below, let me know if they did a split, but I don't remember them doing a split. And they're not even the most expensive share. Of course, if you know Berkshire is super expensive. They're probably sitting at like $500,000 per share. Yeah, they're sitting at 405,000 right now. So Berkshire, of course, there is a Berkshire that's a cheaper alternative, which is going to be a 1-to-1 ratio to this. But yeah, they are expensive. But we're going a little bit off topic, sorry. Let's go back into Shopify. Now, this is the max history of Shopify. For those that may not know what Shopify is, they offer a cloud-based e-commerce platform. The company's platform provides merchants the design to set up and manage their own stores through web, mobile, social media, brick-and-mortar locations, and pop-up shops. I personally never use Shopify, but I have, I guess, a need for Shopify for certain businesses that I do have. Now, Shopify is amazing. It's basically like a way you can just list any products you have, and obviously Shopify gets a commission of the sale, I would imagine, in order to generate some of the profits. But they are super expensive. But they are in the news today because they're actually in the lows. So this is where they were sitting at. They were sitting as high as almost 1,200 per share. A steep drop. They have went down. So I'm kind of curious to see if there's any news in the topic that will like kind of propel this stock to go down so swiftly. But yeah. Let's go take a look. Take a little gander. Now, it doesn't really say exactly why it's going down, but this kind of may be triggering why it may go down this week. People losing faith or they don't believe the potential of Shopify. But according to this article that was released on Wednesday by Benjamin Rains, by Amazon, of course, we know about Amazon, and Shopify stocks before the Q1 earnings for big growth. So in this case, he believes it 125%. It says here, shops popped Wednesday after they slipped to start a busy week. Wall Street now engulfed by the earnings report by bellwethers in finance, technology, and beyond. The next several weeks is posed to showcase strong results compared to the last year's rough first quarter. And that's probably true. E-commerce is huge. Still is, in fact, but it was definitely huge during the pandemic, which we talked about numerous times in other videos. Both stocks are set to report during the last week of April. So yes, next week. Next week will be the time to definitely watch to see what happens with both Amazon and Shopify to see if in fact they will break their earnings report. And if they do, we'll definitely see it next week on the next Steely report. So definitely, if you guys haven't already subscribed, if you guys are curious to see if they will break into the highs next week for Shopify or even Amazon. So yeah, pretty simple for the most part. People are selling out before the earnings report. And I kind of talked about this, but I think last week video, where there's two ways a stock can go. It will continue to go up before the earnings report because people believe in it and they think they will break the earnings report when they do report it. Or in this case, inversely going down because people don't believe they will break the earnings report. And of course, they're trying to sell at a high point to get some profits because after they do release support, it could go significantly lower. And they don't, of course, they want to just kind of cut their loss before it goes even further down. In this case, I don't see them going any further down than what we see now. They actually might go back up to past their 1,200 previous high from this week. They might, I might even see them go 1,400, 1,500. Personally, they are super expensive, but if you do have the cash and you're willing to invest in the long term, they might be worth getting because, as I mentioned numerous times before, I remember when Amazon was like $400, $500 per share. Now they're sitting at 2,000 plus, I think. It's not quite a recommendation because obviously I'm not a financial advisor, but if you guys are looking to possibly get a huge potential gain out of this and you are able to afford it, this will be a big Talos pick for me this week. Shopify, of course, Amazon's always going to be a selection for that, but of course Amazon, of course, even more expensive. But in the if you look at this stock in a 5-year history, like a 5-year trajectory, I can definitely see a stock being easily $2,000-$3,000 later down if they don't do a split. That pretty much includes that. So let's move on to the next topic at hand. And of course, the next topic is actually a surprising one. Netflix being in the news for the downs this week. What happened to Netflix? They're sitting at $505 right now, which is still very, very expensive. But like again, I remember them at $80 at one point. So they're doing pretty well. But they were as high as $554, and then Wednesday, for some reason, they went down right around like almost less than 500 to some degree. But yeah, what happened Wednesday? What happened with Netflix Wednesday? So Netflix Wednesday, that should be a TV show. But regardless, let's see exactly what we can find in this news. Now this is a big one. This is a big one. Of course, Netflix stocks catered after the subscriber miss is now a great time to buy, is what this article is saying. It says here, Netflix stocks often rally in the months after the company falls short on a subscriber target. Charts below. Some of the largest gains have been 12 months after a miss. Unsurprisingly though, Netflix shares are more volatile in the months following a subscriber shortfall, likely because investors determined if the company is experiencing a financial shift in its business for whatever reason. There's a price target of 680 price target. That's a huge price target, by the way. But the biggest uncertainty, of course, is amidst a great reopening of the world from the pandemic as expressed by Netflix guidance. Now, obviously, you guys know this. The reason why the huge growth, of course, was people at home. They have nothing to do, but so they subscribe to Netflix, watch Netflix at home. But of course, now with the reopening, people are going outside, watching movies outside, going to the movie theater, going out shopping outside, playing sports outside, whatever. And of course, people are less likely to be home, so they're going to cancel their subscription, which is what we see here. People that were subscribed to Netflix are now unsubscribed because they don't plan to use it, or they only did it because of the pandemic. That explains the huge downfall on Wednesday. It could only be a minor blimp into I guess the overall trajectory of Netflix. So I don't consider this a huge loss for Netflix. Yes, people probably gonna be out and about, but eventually when shows start coming out, people might resubscribe back into Netflix. So in the long run, it'll still possibly hit that $680 price target that this guy mentioned. Now, another thing to keep in mind too is the highly competitive market that is streaming. We have Disney Plus, we have Hulu, we have Discovery Plus from what I found out a couple of weeks ago. It's everywhere, and Disney Plus has been a huge stride right now. They have great shows right now. They have Loki coming out pretty soon. Falcon Winter Soldier was an amazing product. We had WandaVision earlier, and that was pretty successful. Obviously, we're getting The Mandalorian late in the year. There's huge IPs coming out for Disney Plus, and that's a huge blow to what Netflix could potentially have. Because right now, the only thing I can think of for Netflix that I personally am interested in is probably like Stranger Things. And I think I was told that might come out later in the year as well. But there's probably others out there. But right now, that's probably the big hit right now that Netflix might be facing. Oh yeah, I forgot about Peacock as well. That's also another thing. And they also acquired WWE as a contract in the US. So obviously it's huge. And Netflix is definitely slowing its market grasp right now with these other competitors coming up. In the long run, maybe yes, we'll see a much more significant downturn. But right now, in the short term, I definitely don't see this being a big hindrance. You guys leave in the comments down below what you guys think. Now let's move on to the next topic. The next few topics actually might relate to each other. That's going to be Riot blockchain. We're talking about Nvidia and Coinbase also being there. Now they're all inadvertently related to cryptocurrency. Let's kind of briefly talk about Riot right now. They weren't significantly low this week, but they were in the lows that I want to talk about briefly. And they're sitting at around $38. And basically, for those that may not know, Riot blockchain leverages its expertise and networks to build and support blockchain technology companies. So Nvidia also in the lows this week. Nvidia, of course, is a corporation in the worldwide leadership in graphics, processor, and media communication device. And of course, Nvidia, of course, is like one of the things that people use to mine Bitcoin, Ethereum, whatever. In fact, I have two, the GeForce RTX 2080 Ti's, and they are currently mining Bitcoin as we speak. And it shows here that Nvidia is in the lows. If you look at the chart real quick, they were sitting as high as 630, as low as 592, but Friday they kind of been going up a little bit, but they still haven't been up to where its previous high was. But if you look at its max history, they're definitely been doing pretty dang well. And look at that huge spike. A huge spike around, let me see, was this 2018? It kind of dipped a little bit in 2019 and quickly went up again right around August 2020, and you guys know exactly what happened to them. And that's kind of like why we have a shortage in graphics cards, GPUs, in the market, because obviously people are buying it to mine Bitcoin. If you look at like eBay and other prices, they're like 2-3 times the initial market value. That relates back into Coinbase. Coinbase, of course, being on the lows this week, a massive low, because of course last week they were super high. So they were sitting at a high 338, now going as low as 291. So I kind of want to do like a brief look at to see exactly where this is, and should you be worried, should you be concerned, or maybe you haven't bought in yet and you want to buy it now. Of course, as I mentioned before, typically from a big IPO like this, there's a lot of hype that comes in that first week, and I probably bought into a little bit of that hype, and of course that's when I kind of took a little bit of a hit. But right now, the way I look at it is, if it keeps going down, it just means that I can buy stuff even cheaper. This IPO'd at $250. That was the initial target price when it first came out. So it's still technically above IPO price, but once it starts dipping down below IPO price, I might consider buying in more. For long term, I definitely see a potential with this, but of course, there's a lot of people that might not believe in Coinbase because there's a lot of competition when it comes to the cryptocurrency market. But let's kind of dive into some articles real quick and see if we can find anything that's a little bit more concrete that we could discuss. This is an article from Yahoo Finance. Katie Woods loads up on DraftKings, Coinbase. For those that may not know, Katie Woods is a ARK investor management, and on Tuesday snapped up another 236,000 shares of cryptocurrency exchange Coinbase during the dip. I wish I had her money, because I probably would have done the same thing, honestly. And this article was published on the 22nd yesterday. Coinbase stock falls again towards a fourth straight loss after first non-bullish analyst starts coverage. This is a big one when an analyst like this one puts a negative, like, I guess, buy rate or a sell rate on a stock. Now, as analyst Dan Dolerve, I guess, he broke rank with his Wall Street peers as he became the first person to initially cover the Coinbase with something other than an equivalent of a buy rate. So he's one of the first persons to actually put a neutral rating on the cryptocurrency market and a stock price target of $285, which is kind of like where it's going. He believes that Coinbase was a major stock gainer. The risk of price pressure offsets opportunity surrounding the stock. Over time though, Coinbase's fees may face downwards pressure with competing platforms, following a footstep of zero commission stock trading. That's a big one. We know about zero commission stuff. Obviously, a lot of big stocks already do that. Robinhood's a big one. Public, of course, which is, of course, our sponsor. So if you check them out, zero commissions. And even big ones like Fidelity, and I think also does it as well. And of course, cryptocurrency is no exception. Now, the big kicker here is that Coinbase, a lot of their, I guess, profits come from commission fees. Competitors out there is going to offer a zero commission. That's going to be a huge blow to Coinbase, because how is Coinbase going to earn a profit at that point if they can't compete with those who offer zero commissions? There's other ways to kind of go about it. They can either have subscribers like pay into Coinbase. A good example that I like about Robinhood is the fact they offer a way to, like with Robinhood Gold, they have a way you borrow money from them and then of course use that to invest, and of course Robinhood earns interest from that, and of course with Robinhood Gold you also earn a little bit of like the subscription fees with that. I believe it's like $5 a month. So they're able to make money from there and generate profits and still offer a zero commission. Coinbase can kind of go that route as well, where they can offer a type of borrowing aspect of it, drop it down to a zero commission, and then like every month charge $5, and of course interest based on how much you take and borrow. That would be a way to compete against a market that offers a zero commission. That's just ways to improve Coinbase as an application in the long run. But right now, they are still the market leader when it comes to the cryptocurrency market. But right now, this is what he believes will drop that price down because of the competitors who could potentially take market share away from Coinbase because they offer a zero commission. Lots to talk about. It's still kind of up in the air, but definitely let me know in the comments down below how you guys feel about that. Do you think if they don't change how they think about their business and their business practice, they can actually go down the way and even go lower in their stock value? Even though they had a huge growth in their initial IPO, it doesn't mean in the long run they can compete against those that offer zero commission. I'm curious to see what you have to say. Let me know in the comments down below. All right, guys, we have somebody in the call right now, a good friend of mine, Chris Sora. What's up, man? Welcome to stream.
Hello there. How's everyone doing? How are you doing, Talos?
I'm doing fantastic. Thanks for asking. No one actually asks how I feel sometimes.
Well, I care. I know others don't, but I care.
And of course, I care about you as well. Obviously, Chris Soared is a good friend of mine. Not only that, but also another contributor here in the Studley community. Now, we're not going to reveal exactly what we're going to be eventually doing in the channel, but it's going to be major stuff. But we'll talk about that more later at the end of this video. Now, let's go and talk a little bit about Square Enix. Obviously, it's a Japanese company, so it doesn't have any public IPO here in the US. You can buy it over the counter. You need your own Japanese like brokerage account and all that. I really don't know the full extent of it, but I would imagine the same as the US. However, Square Enix. Chris, what do you know, I guess, about the Square Enix stock?
Not much. You're the stock boy. You teach me all about stock. But I guess what I know about it is kind of been flatlined for a while at about the same price for a good few years. It's climbed a little bit, but not too much.
And we can take a look at the chart as well. So let's flip over real quick. So this is their 1 week history. Actually, the 1 week history is actually pretty good for the most part. I'm assuming this is in yen, so 3,400 yen up to 6,300 at the ending market.
That's not bad.
This is the 1 year history, and like he's saying, it's pretty much stagnant for the most part.
It's really interesting for people that have never really looked into stock before, because I'm with you. I'm one of those people that just doesn't understand it, and my mindset always was, oh well, if you buy Square Enix stock when there's like no big games, surely it would go up when there's like a big release, like a Kingdom Hearts 3 or Final Fantasy 15 or Final Fantasy 7 remake. And just for the people that have that mindset, if you look at the chart, it doesn't match up at all. Like for me, I thought Final Fantasy 7 remake, that stock is gonna skyrocket. Such a big release, and it doesn't seem to. And I think that's one of the big things to remember is Square Enix is more than just a video game company, and I think that's why it probably doesn't skyrocket.
Typically, you don't see big gains until people see how much money that game has made. So it typically takes like either up to a year or more sometimes. There might be a bit of a bump, but you typically don't see that because investors, they don't care about the initial hype. They want to see how much money the game made throughout the course of the year. The game came out April, right? So yeah, April 2020. So this is the gain right here. So June 2020, there was a spike there. So we're now seeing the feedback of Final Fantasy 7 Remake right around here. And then it spiked up yet again around the holidays, which is of course going to do that, or closer to the holidays. And then it kind of went down a little bit on November, and then kind of back to where it was because of the holiday. So that's why it peaked around here.
Yeah, I know around that January section is actually where they did their Final Fantasy 7 sale. That's quite interesting to see. You can see where the sale, when they do their little sales, you can actually see where that builds up the stock.
The reason why we're talking about Square Enix is not necessarily about Final Fantasy 7 Remake, but of course it was in the news last week. We didn't really cover it last week because I thought it was more of a rumor, so I really don't want to cover rumors per se in this channel. But apparently, Sony and Microsoft was potentially trying to buy out Square Enix as a whole. And of course, Square Enix is more than just Final Fantasy. Like Crystal was saying, they have Kingdom Hearts. They have the Nier series.
They also, so if we're talking about not games, they have an extensive manga division. Square and anime as well. They produced Full Metal Alchemist. People who know Japan will know that there's Shonen Jump, where, you know, stuff like Dragon Ball and all, they own. Shueisha owns Dragon Ball. Square Enix owns Gangan, which owns Full Metal Alchemist and all these other big manga titles.
Wow.
And that really feeds into a lot of where this rumor and stuff fed into, because a lot of people will think of Square Enix because of their video games. So Sony and Microsoft, while they may have had an interest in the games division, Square Enix Holdings, which is the entire corporation, the umbrella company of which the Square Enix games division, Gangan, all the others are under, while they may have had an interest in the games division, they didn't seem to quite have an interest in anything else, and they were kind of going after the games division. And
going back into the charts real quick, if you scroll down a little bit, we can see the market cap of the company sitting at 761.5 58 billion yen. If our math is correct, we should be sitting at around 70 billion US dollars.
58 billion euros as well.
And what's crazy about that is technically Microsoft and even Sony can buy, because if you look at Sony stocks, Sony's market cap is 136 billion and Microsoft's cap, 1.79 trillion. And that's US dollars, of course. So technically Sony maybe could buy Square Enix, like of everything, but Microsoft for sure has the money and backing to buy Square Enix. But of course, ultimately this was denied by Square Enix officials itself.
Even though Microsoft would definitely have the more money, Sony would have the better chance of buying Square Enix, because Sony are also a Japanese company.
Yes,
and
that's a good point.
It's kind of a culturalism thing where a Japanese company can buy a Japanese company, but Square Enix wouldn't be as quick to cut a deal with an American company.
It will probably be huge for Microsoft because obviously they're trying to set a foothold or foot stomp in the Japanese market. But as we all know, it's very, very hard for an American company like Microsoft to have a foothold in the Japanese market. Another company we forgot to mention that also was in the talks to buy is a company known as Tencent, a Chinese-based company. But regardless though, yeah, ultimately denied, but it kind of has that thought like, ooh, maybe that could be a potential. As Chris Soared mentioned, they aren't just a gaming company, but entertainment company. They do video games, also a mobile, arcades, cloud gaming, and manga.
And let's actually not forget as well, they have their own movie division. And although their movies so far have been related to the Final Fantasy games, it is still a division in the company that would actually be separate from the gaming division. But
yeah, before we go to the next article here, this was updated about 3 days ago. Obviously denying that rumors that is up for sale. Apparently there is a statement here. Bloomberg has reported today that there is an interest in several buyers to acquire Square Enix. However, the support is not based on any announcements by Square Enix Holdings. We do not consider selling of the company or any part of its businesses, nor have we received any offers from any third party to acquire the company or any part of the businesses. So the one thing I find interesting though is who started this rumor? Like, how did this even start? Like,
I do know thought this could have been legit is because this rumor, it started I think about a month or two ago with Sony's considering buying Square Enix. It had been like a whole little rabble talk thing for a while. When this story really kicked off was when Microsoft got mentioned. And that's when all these places started picking it up of Sony or Microsoft could pick up Square Enix. DualShockers is a legitimate website. Bloomberg, of course, legitimate website. Anime News Network.
What I find fascinating though, like if we go back to like the what ifs, if they like, let's say Microsoft somehow does buy Square Enix. Like now we're talking about exclusivity stuff. Now we're talking about like look at, for example, when they bought Bethesda. They're thinking about future titles eventually being an exclusive title, games for the Game Pass, for example. Now we're talking about like the remake 2, or a sequel to remake for Final Fantasy VII being exclusive for Microsoft. Going back into the investment standpoint of this, if you guys are invested in Square Enix and are in for the long haul, obviously definitely hold, because there is no selling of any company like that into either Microsoft or Sony or even Tencent. They have a lot of ups and a lot of downs. They're definitely the highest they ever been, because the previous high was back in 1999. Of course, 1999 was when they had. So 1999 was more like FF9. I think before the merger, actually. It was probably before the merger.
But I think the one thing to consider with that would be that FF7, which would have built them up, and then FF8, and then FF9. So I think 7 really built them up.
And of course, the downfall here is FF13 and 13-2 and all that. Lightning Returns. It kept going down and down.
Here's that 2013.
Yeah,
is
2013.
That when it starts going up? That's when they announced Final Fantasy 15 and Kingdom Hearts 3.
Oh yes.
So that makes a lot of sense.
Interesting stuff. Obviously, guys, let us know in the comments down below. How do you guys feel about this? Obviously, it's kind of a sigh of relief that they are going to remain as Square Enix. The what ifs is going to be even more terrible. If it's Microsoft, we're talking about exclusivity for Xbox. If it's Tencent, then they're going to be jumping into like the mobile bandwagon and like doing like microtransactions and Fortnite stuff merging, which might be okay, I guess, but at the same time, it's still going to add in that that microtransaction vibe to it that we don't like, that stigma of 10 cents. And if it's Sony, I think Sony will be the best bet to keep it as is, but at the same time, like, it's better just kind of keep it as. Yeah. So yeah, regardless guys, that's all we got. And thanks again, Chrisora, for your comments and feedback.
Happy to be here.
Before we head off, a quick announcement. Obviously, Chrisora is going to be an added source into the study community. We're going to be doing a lot of exclusive content in terms of like entertainment style news. And of course, that involves movies, TV shows, streaming platform style shows like Disney Plus and Netflix, etc. so forth. And we'll also be doing another exclusive show, but we'll keep that under wraps until more finalized news on that. So definitely get excited for that. And of course, we'll definitely be seeing and hearing a lot more from Chrisora. Thank you again, Chrisora, for your feedback. And of course, that pretty much concludes this video, guys. I hope you guys enjoyed today's weekly studly stock support with your host, Talos. Now, of course, more content coming out with Chrisora. He's going to be officially part of the Steli community. Now, of course, we're going to incorporate a lot of new content coming out in the Steli community channel. So if you guys want to see more of that, definitely consider giving us a subscribe. And of course, if you enjoyed the weekly Steli stock support, definitely consider giving us a like. Definitely helps support the show. And of course, if you guys want to go above and beyond, definitely check out our sponsor, Public, for your own free slice of stocks worth up to $50. Now that's pretty much all I got. So until next time, this is Talos signing out. See you next time, guys. Laters.